reward sometimes leads to greater loss. So you also have that liquidity risk, right? So like if you're leveraging and you owe a certain amount of money to the bank's going to want that mortgage payment every month, no matter what. And so it doesn't matter if you have a vacancy, that liquidity risk is always there, right? Mm-hmm. Market risk, liquidity risk, but definitely a lot of tax advantages also, right? Mm-hmm. So one question we get all the time, Bobback, should I buy real estate just to save on taxes?
It's a good question.
Keyword being just, right?
Yeah, yeah, I think we probably get that question from a number of our clients every year, as well as just questions related to real estate in general. But the usual response we like to give people, and it's I think pretty good advice, is you shouldn't make any investment decision based on tax purposes. You should buy a piece of real estate if it's a good investment, not because you're going to save some money on your taxes. Now, that being said, most people who are buying their first piece of real estate, we will advise them this is going to be good for your tax situation. You're going to save some money on your income taxes by being able to deduct your mortgage interest and your property tax and your tax returns. But beyond that, a lot of times people ask, like, should I invest in a rental real estate property as a tax write-off? And it's kind of a misconception that there's going to be any tax write-off there. Mm-hmm. It should be an investment that makes you money,
right,
which results in paying more tax.
Yep.
Not the opposite. You don't want to buy a piece of property that's going to operate at a loss just so you can take a loss on your taxes. Mm-hmm. That's not a good investment. But yeah, in general, should I invest in real estate? Yes, it's a good long-term investment, but you shouldn't do it for tax purposes.
Right. Make the right business decision, and keep in mind the liquidity risk. Right. That is the biggest risk involved with real estate, is the liquidity risk, that you won't be able to get your money out if you need it, and also that you won't be able to make your mortgage payment, in case you have a vacancy and things like that. So a lot of good points we're talking about today. Mm-hmm. Let's talk tax. Right. That's what we showed up here for. So. Mm-hmm. First off, when you're thinking about going out and purchasing a property, what is the structure that we should be looking at? Why are certain structures more common than others? Specifically like the LLC is a very, very common legal structure to buy real estate in. And then, let's talk a little bit about that. So why the LLC? Why is that? Why do we see a lot of LLCs, or why do we actually recommend a lot of LLCs to clients?
Mm-hmm. I can start on that one. I guess two things jump out to me. One, first off, why do we see real estate, rental properties, commercial properties, whatever it may be? Why do we see those going into LLCs? One reason is, putting your property into an LLC or any other business entity will possibly provide the owner with protection from personal liability for that property. So if there were a damages claim, or there was an issue with a renter, or any number of problems that you could have with your real estate investments, our goal would be to put that property into an entity like an LLC. Yep. If provided that LLC and corporate formalities are taken care of, I'm saying separate bank accounts, kind of things of that nature. That LLC should provide you with liability protection, and keep creditor or damages claim from going after those people coming after you personally, or going after your own house or your own bank account and things like that. So I think that's one reason we recommend putting properties into LLCs or other business entities, is the liability protection. And then LLCs in particular, I think in the grand scheme of things, an LLC is easy to set up and operate. Mm-hmm. There is costs in doing that. There's filing costs, organizational costs, and annually you pay $800 minimum tax to California if this is a California property. So there is some cost in doing that, but in general, the LLC is very flexible. I would say low cost, low maintenance on the entity itself, and it's going to provide you again with that liability protection that I care about. As the attorney, I hate risk. I hate taking on liabilities unnecessarily. I kind of view the business entity or an LLC like it's like cheap insurance almost. I'm not saying don't carry insurance otherwise, but I think that it can provide you with more certainty that you're not going to be subject to a personal claim or something like that.
Yeah, I think also you'd probably say it depends on how the LLC is structured. Mm-hmm. and who's managing the LLC as to the liability protection, and then you're also protecting yourself against maybe your partner's creditors and things like that, right?
Yeah, let me mention that as well. Previously I was kind of maybe only touching on one aspect of property ownership. If you have like a single member LLC or you're a single owner, but absolutely when you have multiple owners, multiple members, an LLC again provides flexibility with how management and ownership and some of those things are governed. And again, as you mentioned, you shouldn't be subject to creditors' claims or things like that from your partners.
Right.
And I suppose if you were operating like as a general partnership, or something like that, not an LLC, then there's more risk that you could be pulled into personal claims against your partners. And I guess the one other thing to mention, multi-member LLC, you also get that pass-through taxation treatment,
Yep.
which is great. You don't see it that much, but sometimes you'll see people put properties in like a C corp. That's not ideal because someday we're going to sell that property and have to pay corporate level tax and tax on dividends. So just kind of not an ideal structure. If it's a rental property, rental income, we should just pass through to the owners. We shouldn't be paying two levels of tax there. So again, I keep saying LLC, but that's just kind of what I see the most, what I'd usually recommend.
Yeah, so the LLC is a legal structure, right? And by default, if it's a single member LLC, it's taxed as a disregarded entity. We file it as if it was, held in the individual's, from a tax perspective, as if it was in the individual who owns the LLC's name. If it's a multi-member LLC, then by default, we're being taxed as a partnership. And, the limited liability portion, that those two letters do have a tax effect, but it falls under the partnership rules, and, like at-risk rules and things like that. But that's a little high level. So let's talk about partnerships in general. LLCs and limited partnerships, probably the two legal structures that we see the most with real estate when there's more than one member, one partner. So let's talk about partnerships and the taxation of partnerships, right? So who'd like to kick it off?
Yeah.
Partnership.
With respect to real estate.
Well, obviously, yeah. We're talking about real estate today. Yeah.
Yeah. How is the partnership taxed, though? Is that kind of what you want to cover?
Well, yeah. Let's talk a little bit about that.
Yeah. I think it's important to talk about the partnership, how that's taxed, versus what Mike was saying. If you tried to hold real estate in a corporation versus a partnership, it just probably wouldn't make sense.
Yeah.
So, I think the question that we get sometimes, and most people think about, is I'm buying rental real estate for the first time. Do I need to put it in an LLC? Do I need to set up a separate entity at all?
Yeah.
And, Mike touched on a lot of that with the liability that you get protecting yourself. But some people might think, oh, well, I already have an S corp that I'm operating my business
right.
in.
Yeah.
Or maybe I'm buying a piece of real estate that I'm going to now operate my business in. Shouldn't I just put it into my S corp? I already have an S corp. And I think that's logically probably makes sense, but without knowing the little nuances within the tax code, you wouldn't know. It doesn't make any sense. Putting the real estate into a corporation, it's going to cause you difficulty trying to take it out of that corporation at any point.
Yep.
Or even if you need to shut down your business, but you don't want to sell the real estate, that's going to cause some problems. And again, if you have partners, like Mike mentioned, you definitely don't want to just own it in your own name. You want to set up an LLC and put your partnership, create a partnership. It's going to be taxed as a partnership because LLCs aren't recognized by the IRS that way. So the taxation is going to be ideal as far as disposing of the property, right, and operating it within the partnership the whole way through. Probably worth noting, like taking a step back too, like a partnership for most individuals that are buying real estate, maybe they're not aware of how partnerships are taxed, but there's partnerships don't pay their own tax, right? They flow, the income, rental activity flows through to the individual return. So you just create basically a separate level of protection liability-wise for yourself, a more easy way to dispose of the property if you need to sell the property. And let's say the three of us were going to buy a piece of real estate together.
Yep.
We would set up an LLC, operate it as a partnership. That creates an easier situation for all potential future outcomes, right? One of us might want to leave the partnership at that point, right? We don't want to have to sell the real estate just because one of us wants to leave.
Right.
And we don't want to have, let's say, God forbid one of us were to pass away. Same thing. What are we going to do with this? We don't want to have to sell it to provide the shares to that person's heirs.
Right.
Mm-hmm.
So the partnership provides an easy solution for all these things.
Yeah.
The LLC, right? Taxed as a partnership provides all these things, which we wouldn't have in a corporation, an S corp or a C corp.
Mm-hmm.
Yep.
All these things make a lot of sense, but majority of people probably just go and purchase the rental real estate without thinking about these things first.
And then I guess from a more like nuts and bolts level with the partnership, then as Bob mentioned, all the activity is reported on a partnership tax return. Whatever your income you're bringing in, and if it's an income producing, minus your expenses, your legal fees, your management fees, your insurance, those kinds of costs, you arrive at your net income amounts, and then amongst us partners, we'd all get K1s out of that tax return that would give us our proportionate share of partnership income and partnership items that then we'd pick up and put on our individual 1040 tax returns. Yeah,
good point.
Yeah.
I think rule of thumb in my head is the partnership is actually a superior tax and accounting structure because of its flexibility than an S corporation is.
Mm-hmm.
The only reason S corps are so popular is because they filter out self-employment tax, right? But when all you have is rental income, you're not dealing with self-employment tax in the first place.
Right. So that structure is better for like a service business or something.
Yeah, exactly.
Something, right? Okay. Yeah, that makes sense. And as you meant, you wouldn't, because you have the right structure for your service business, that doesn't mean that that's the right structure to put your real estate in.
Yeah.
So I get, that's a good point. That different purposes for those entities. So it is important to set up the separate entity for your real estate.
Yeah, and then continuing on the narrative that Bobback started with, the three of us owning a piece of property in an LLC. I'm going to take it a step further. It might get a little technical here, but bear with me, right? Mm-hmm. So three of us are going together, and we go and we buy, let's say, a $450,000 property, and we're a third. Bobback puts in $150, Mike puts in $150, I put in $150, right? And then 10, 15 years later, that $450,000 property has appreciated to $900,000, and Mike decides he wants out. He needs to cash out, or he sees another opportunity that he wants the cash to go jump over there because he's doing so well as a real estate investor, and so he wants out. And either Bobback and myself are going to want to buy Mike out, and Mike's not going to sell for $150. He's going to sell for the new appreciated value, which his share is $300,000, a third of $900,000. And so, maybe Tiffany, our engineer behind the camera, is actually going to jump in, and she's going to decide to buy Mike out at that $300,000. So one thing that is unique to the partnership is that from Tiffany's perspective, we're able to do a basis adjustment and make her whole off the balance sheet of the partnership, but still before she receives her K1, so that she can begin to depreciate this that piece of property as if she had purchased it, as if the partnership had purchased it at $900,000, right? And so that makes her whole, and allows her to recover the full cost of her $300,000. Where in a corporation, in a corporate structure, S corporation or C corporation, her basis would be stuck outside of that corporation until she decided to sell her units, right? So little high level there, but hopefully people follow this.
And what about what's the tax impact on me then when I get bought out?
So you're gonna. Well, you know what the tax impact is.
Well, I know. Just I think I'm paying long-term capital gains right on the sale of my partnership interest.
So it depends, right?
Yeah.
It depends on the underlying asset. You do have to look at the underlying assets, right, and make an allocation. But real estate's tax favored anyways, right? So yeah, good point there. Okay. Let's talk a little bit about the distinction between like a profits interest and a capital interest, also unique to a partnership structure, because it's going to come into play later on in the program when we talk about those high-level carried interest topics.
That's a good point. Yeah. So usually you can't really think about this other than with an LLC, right? In a partnership structure.
Profits interest, yeah.
So three of us are going to buy a piece of real estate like we talked about. Mike and I are going to put up the money. Gabe's going to do all the work on the property. Right, so this LLC allows us to do that. You can't do that in a corporation or an S corp or in a C corp, right? And I mean the common situation that you usually see here is like one person is financing, and the other people are doing running it, right?
Development or management.
So that one person or financier is going to have a capital stake right?
Yep.
Because they're the ones that are putting in the money, but they may or may not have a profit or loss stake. That's unique to an LLC, right? In a partnership structure, you can have a different capital ownership. We can say the three of us are going to be a third each, but since I'm not going to do anything on this property, for example, you guys will take the profit and loss allocations. I'll have a 0% stake in the activity year to year, but when it sells or when I want to sell my stake, my third ownership will be cashed out, right? So that's what you were trying to get at, right, Gabe?
Yeah. So there's a number of ways you can structure it, right? Like any deal that individuals can think of, you can put on paper and run through a partnership.
Yeah.
For the most part, unless they're abusive of the tax of the tax code, right? So like disguise sales and things like that, high level stuff, right? So talking about the profits interest versus the capital interest, one way to think about it is if the person putting up the capital, if the day after they put in the capital, the partnership were to dissolve, everything that's in that partnership would go to the person who fairly put up the capital, right? Unless there was some kind of capital gains or there was some rental activity income that netted a profit, that would get allocated per the profits allocation written up in the thing and the operating agreement or partnership agreement.
Yeah, that makes sense. I think that's a good example. If you just shut down the thing the next day,
right,
why would the profits interest member get
anything
more than what they put in, which was at this point, no capital. So I think that makes sense. They're earning their share based on the operation of the property or the development of the property or, whatever value their services are intended to bring. They're going to get it eventually through their profits interest. So I think that's a good example.
Great. Yeah. Before we jump on to the next topic, any other tidbits that we want to talk about on the partnership? Let's see. I'm looking at my notes here. So generally non-taxable distributions that is subject to basis, right? Basically the money that you pay tax on either before you put the money in the partnership or as the partnership has been operating, and yeah, okay.
Yeah, I have two quick thoughts that come to mind because we're kind of talking in a bit of generalities in some cases,
right?
But yeah, I think what you were kind of just getting at is sometimes partnerships produce income. And as we mentioned, we get our share of income on our K1s or whatever, but there may not always be cash to back that up. So, there could be circumstances where, we need to, our property or whatever, our partnership is producing income and we're getting our corresponding share of that. But at a partnership level, we may decide, let's reinvest that money into new property or improvements or something like that. So there could be a mismatch between the cash and the income coming out, which sometimes at the end of the year when you guys are doing tax returns, right, your clients don't like to see that, right? Because they're saying, why do I owe tax? I didn't take
phantom income.
Yeah, phantom income, right? I didn't take any money out. Yeah. So that's one thing. I mean, it doesn't always happen. That's not the intent for that to happen, but there could be business or economic circumstances that kind of take you down that route.
Yep.
Yeah, and one other thing I want to mention, we didn't spend much time at all on it, but an LLC, as you mentioned, a multi-member LLC is taxed as a partnership by default. Another entity you sometimes see with real estate is the limited partnership.
Yep.
I would think, in my mind, it's kind of more historical. Before the prevalence of LLCs, like the limited partnership was the desired entity, and still people use it. Kind of in the developer passive investor context, you see it a lot.
Yeah.
And again, taxed as a partnership, that's going to be similar. Some of the other things we covered, you do see that profits interest stake more with a developer or general partner in that context. And then the one other thing is a limited partnership has something called a limited partner,
right,
which is like an investor, and they have no liability, similar to an LLC member. But then you also have somebody called a general partner, usually just one, and that general partner actually has unlimited liability.
Right.
So there's ways to mitigate that. You make your general partner an LLC itself or something like that. But that is a structure that's operates similar to the LLC and taxes a partnership, but with some kind of nuances there to be mindful of if that's the entity you're investing in or that you're using for your properties.
Got you. Yeah, and you remind me of one more thing about the LLC versus an S corp, right? S corps can't have non-resident members. right? You're talking about investors. We have a lot of foreign investors coming into our market.
True.
So that's a good point there.
Yeah.
So I'll take a little bit of time and I'll talk about some of the cutting edge stuff that came from the Tax Cuts and Jobs Act that went into effect in December, just 7.5 months ago, right? And so this is really new stuff, and there are opinions that are brewing right now, among attorneys and CPAs and EAs in the market. And we're really just waiting for the IRS to release their proposed regulations that will turn into permanent regulations, right? So the IRS still hasn't weighed in and given us their opinion on this, but the Section 199A deduction, right, or it's been coined the 20% pass-through deduction, right, which at a high level, if you're getting pass-through income from a sole proprietorship, S corporation, or a partnership, and whatever that net income is, you can take a maximum of 20% of that and deduct it from your income before calculating AGI, right? And so this is completely new stuff. And so if you have, a rental activity, the question becomes, does it rise to the level of a business? Because it's actually called the qualified business income deduction. So we're talking about business, right? And so like, in the code, right, Mike, sometimes real estate and rental activity is considered a business, and sometimes it's not considered a business.
So passive activity.
Yeah, exactly, right. So the passive activity rules, right, there's a higher threshold for rentals. So in that setting, it's not like a business.
Yeah.
Right, but you still get to depreciate the property that's underlying and creating this income, and so in that side of the code, it is considered a business or a trade and business, right? And so that's part of the question whether or not rental activity qualifies for this partnership, but this pass-through deduction. Okay, and then I also want to take it another step further and talk about your high income earners, which, if I'm looking at my notes here, we have married filing joint in excess of $315,000 total taxable income, and then individuals filing separate or single, $157,500 taxable income, with way down there on the 1040. You got income, you got deductions for adjusted gross AGI, and then after AGI, then you have taxable income, right? So once you exceed that, you start playing with these rules, which say that you have your maximum deduction can only be 2.5% of the unadjusted basis of the property. And so what are we talking about in unadjusted basis? And this is going to segue into 1031 exchange and the next section that Mike's an expert at, is we're talking about the depreciable portion of a property. So, like what's the difference between land and dwelling when we're talking about depreciation?
Yeah, that's a good question, right? So people often buy real estate, they assume they're going to get a deduction for all the depreciation, right?
Yeah.
They buy $1 million property, they think they get to depreciate that. So we have to split how much of that $1 million is allocated to the land and how much of it is to the actual building itself.
Yeah.
So the depreciation that you get to take is only based on the building. Land is not depreciable, right? So if it's a commercial property, we're going to take it over the 39 years, and if it's a residential, 27.5. But we don't get to ever depreciate the land, only the building. So
right.
What you're getting to on this, right, is the 20% pass-through deduction, right?
Yeah.
Is going to be limited by this unadjusted basis, right?
Right, exactly, yeah.
So the term basis actually refers to how much your cost is on this place. So it's adjusted by depreciation, and unadjusted would be prior to depreciation.
Correct, yeah. And so if the dwelling is fully depreciated, it actually falls off. So this rental activity, the property being fully depreciated would mean that you would get zero deduction. So you do have to have some basis that is depreciating. So I'm going to move on. Let's talk about 1031 exchange. Mike, you've been party to or aided in many 1031 exchange transactions, right? Yeah. So why don't you kick it off for us?
Yeah, that's good. I'm happy to talk about it. I've been with 1031 exchanges, I'm planning these transactions, helping clients execute them, as well as kind of dealing with the other side of the transaction, which is sometimes these get audited and looked at, and kind of learned a bit of the ins and outs of how people get tripped up in these types of transactions. But in general, what is a 1031 exchange? It's a like-kind exchange, and it's kind of something developed, for policy reasons in the United States. But the idea is that if you sell your property and you then take your sales proceeds and reinvest those in new property, you can defer any tax you would have paid on that sale.
Yep.
So why would you do this? I mean, it kind of makes sense, right? You buy your property for $1 million, you sell it a few years later for $1.5 million. And you have $500,000 of gain there, and you turn around and have to pay taxes, federal and California taxes on that. But if you in turn around and reinvest that money and put your full $1.5 million into real estate, have any cash anymore to pay those taxes.
Right.
So it's kind of like disincentivizing people from investing their money and investing in real estate. And one thing the U.S. government likes, at least from a policy standpoint, they want the people to live the American dream, to invest their money, try to prepare for the future, build a nest egg, build a retirement, all of those things. So from a policy standpoint, it's an planning opportunity to, on sale of a property, reinvest those sales proceeds and pay no tax. So that's what everybody likes to hear, right? I mean, that would be the dream. And let's say you can do this multiple times. So you can buy a property in your 20s or 30s, and 5 years later get a new property and keep exchanging this property until you're 50, 60 years old, and now as real estate market goes up, you're making new investments at the right time, and you've avoided paying tax for 30 years or 50 years or something like that,
right,
and grown your leveraged money into a much bigger parcel of property and gain for you. So I think it's certainly relevant in any real estate investment. But again, what we're talking about now is we've kind of talked through the life cycle of why people invest, what type of entity you put it in, how you pay taxes, and then when you're getting ready to sell, that's when the 1031 exchange comes up. So that's kind of a little background there. People do get tripped up on these, as I mentioned. So it's technical how you do it. There's a lot of requirements. You sell your property within 180 days. You have to put your money back in. Earlier than that, within 45 days, you have to identify replacement property. You need to use a qualified exchange accommodator, which is a third party that helps you do these transactions. Why is that? Essentially, when you sell your property, you can't take the money and put it in your pocket and then take it out of your pocket 180 days later to put in a property. The IRS in California require that you use the exchange accommodator to hold that money for 180 days so you can get into your next property. So that's kind of a little background. I really think probably the first conversation I have with my clients when they're contemplating selling their property, can we do a 1031? Are you going to put your money back in? And one other thing that some people don't realize, if you sold that property for $1.5 million, you don't have to put the whole $1.5 million in. If you put in $750,000 or $1 million of that, then you can defer half or 2/3 of the gain or something like that. So you can do a partial 1031. So it's always there. Always there is a good option.
And one of the questions I think we get a lot is what when it comes to 1031s. I'm selling my house.
Mm-hmm.
I've heard that I don't need to pay any tax on this if I do a 1031. But obviously not with your home.
Right. Your principal residence, right? Absolutely.
Good point.
It's a common question that we get, and I think it's a misconception people have in their head. They can take a 1031 exchange on any piece of real estate ever that they want to. But the tax code's actually built very well for excluding capital gains on your primary residence, right? So you get to exclude $250,000 on your primary residence for each person, you and your spouse, on the home. So if it's not your primary residence or principal residence, and it's an income property, then we get to look at the 1031 options. Right?
That's right.
Are there any situations where, because sometimes people want to ask creative questions, where we can take a 1031 exchange on your principal residence? Any creative ways to do that?
Well, in an easy way, in an easy manner, no. But I think you kind of touched on how you'd get there. You'd have to, make it no longer your principal residence. I think, and turn it into an investment property, and then you're kind of walking a bit of a gray line there. But if you rent it out for a period of time, or put it to rent, or acquire another property, or you can show you moved out or something like that, I think those kind of facts help.
Yeah, I think so. In the code, it says if the property is held for investment, trade, or business, if you're living in it, that nullifies that.
Yeah.
And then I'm pretty sure, don't quote me on this, but I'm pretty sure the safe harbor is 2 years. So if you rent it for 2 years, then it should qualify for a 1031 exchange. But in those scenarios, you need to consult a professional, and we need to go actually do the research for it.
And even in selling your principal, you still get benefits, right? Just even if you don't do a 1031, just by sale of your principal residence, right? You can exclude $500,000 of gain, or
it's often better.
Yeah, so that could be
tax-free money,
just as beneficial. That's right. And one other thing to build on what you were saying, you can sell. Let's say you had a rental property and you want to go buy a commercial property or strip mall or something. You can do that. Mm-hmm. Like kind doesn't mean rental property for rental property, or home rental property for home rental property, or condo for condo, or anything like that. It just means interest in real estate for interest in real estate. So you could sell your rental property and you could buy REIT units, real estate investment trust.
Oh, interesting.
Trust units. Those are even replacement property, and that's kind of more like a securitized type thing. You can't buy a partnership interest, even if the partnership holds real estate, because that's not considered real estate. But most kinds of real estate are a TIC interest, REIT units. So there's a lot of things out there.
Yeah, and so you mentioned partnership because we were and we were also talking about LLCs and partnerships earlier. Mm-hmm. So if a partnership is the party that is selling the property, the partnership is the one that has to acquire the next property. Yeah. You can't sell it as a partnership and then buy it as individuals.
Absolutely,
that doesn't work.
That's absolutely right, and that's probably one of the other areas I see where people get tripped up.
Yeah.
Most commonly is they say, let's say one of our other examples. Oh, Mike wants to leave. So let's buy him out. Then let's have the remaining partnership do the exchange transaction.
Yeah.
There's a little more technical than probably what we're covering here, but there's drop-in swaps and these types of things that people try to do, or tax advisors sometimes recommend, but they're not without risk. So I guess the way to think about it is you had to hold this property as an investment property, right? So that would mean that what the IRS looks at is that you actually held it as an investment property, not you held title to it in this manner the day before the exchange happened. Mm-hmm. You need that backstory, that history for the last year or 2 years. It was held in that manner.
Interesting. I like this narrative. So in this narrative, we keep on buying Mike out.
Yeah.
Gabe's doing all the work.
Yeah. Yeah.
Bobback, you're coming up on this one.
Yeah.
I'm happy with it.
It's a good scenario so far.
Yeah.
One of the solutions that we've used a couple times is I want to sell my rental property. I don't want to pay all the tax. How can we avoid this, right?
Mm-hmm. Yeah.
And that kind of touches on a few different issues, but the general idea that a lot of times that I try to pass on to people is, can we make this your primary residence for 2 years? Because if we can, then we can exclude gains, right? Mm-hmm. With the exception of the depreciation that we had over the years that has to be recaptured.
Right.
Mm-hmm. Right. The 1250 gains.
Yep.
So that's sometimes a solution if the 1031 is not an option, or they want to liquidate,
right,
for example, and they're not looking to buy another piece of property. They actually want cash in their hands, but they're not looking at paying so much in tax to do that. Mm-hmm. So I just thought I'd mention that part because we've done that a few times with some of our clients, and it seems to be a good solution.
Okay. Yeah, it seems like a good option in that circumstance if they can do that. Yeah,
if you can hold on for a couple years and live in the property. Yeah.
Mm-hmm. Mm-hmm.
It's a good planning opportunity there, right?
Yeah.
So as a minimum, if you don't want to pay tax, you have to take all the funds and all the gains and buy a property that is equal to the fair market value that you're disposing of, or greater, right?
That's exactly right. Yeah. Total value, like total sales price, all needs to go into your new property in order to defer all the gain. And there's even more nuances to this. You have to replace the debt that you had on that property, or you could have taxable boot in the exchange.
Yep.
But yeah, that's the concept. Your entire sales proceeds, including the debt that's in there, need to go into your new property or properties. That's something else. You could have 2 or 3 or 4 or 5 replacement properties as well. But as long as the total value of those properties is consistent with the sale value, then you should be able to defer the full gain.
Yeah.
Yeah.
Any maximums?
A cap? No, I don't think there's anything like that. So, so I'm saying back-to-back exchanges for many years. You're going to be a pretty valuable property.
Three property rule, 200% rule. Attorneys don't deal with rules.
Okay.
they figure out how to get away from them, right? So.
What about, Mike? This is a question for you. If you're holding a property and you 1031 that,
Mm-hmm.
and then you hold that property, you 1031 that next one, and then you pass away,
Mm-hmm.
what happens at that point? It goes on to your heirs. We have tax to pay at some point here, right?
I think that circumstance would be probably a favorable one because you are deferring the gain on the exchange, and then your beneficiary who inherits the property is going to get a step up in basis in the property.
Right.
So I think that is maybe a perfect circumstance for holding real estate and then passing stepped up basis to your heirs. So
that's kind of what I was getting at. It seems like if you wanted to and you didn't need the cash, you could use that as a way to pass on income or pass on assets to heirs, right? As long as you're not above the threshold for estate taxes.
Yeah, I think that's a good point as well.
Tremendous.
And one thing that maybe I kind of glazed over here. One other thing to be mindful of is if you own California property and you exchange property in Nevada or Idaho or some other place, California actually tracks that because someday when you sell it, your Nevada property or whatever, California wants their share of appreciation in California. They don't take it in that exchange date, but it's on your tax return. You're reporting this to them, and you're supposed to report it to them eventually when that gain recognition event occurs. So,
California wants their money.
Yeah, they do. They're very, very aggressive. Yeah.
Should we talk about you mentioned some taxation audits related to 1031 exchanges.
Yeah.
What have those been like for you?
Well, what's interesting about that is it's good time to bring that up. All of them are California audits. I don't know why. I don't know why this is the case. It seems like the state of California has put a lot of resources in their examination of 1031 exchanges, but I would say basically every 1031 exchange gets examined by the state of California.
Interesting.
Yeah,
Wow.
where I've only seen it on the federal side in audits of other issues that kind of have expanded to the entire tax return. But California is customarily looking at and auditing every 1031 exchange that happens. So that's one takeaway, is that be mindful of that. You can't cut corners because it's going to be examined. People are going to look at it. So I think one kind of the issues that we kind of encounter there. If you're using a qualified exchange accommodator like you should be, they kind of cover most of your bases on some of the nuts and bolts, like 180 days. Making sure you put the full value in. Things like that are obvious. Where the attorneys get involved more tends to be on the planning, and it's kind of building on what we've been talking about already. You see it a lot where you have a partnership or an LLC, and not all the members of that transaction are going to be owners in the future property or something like that. So it's this concept that the FTB and the IRS will always need to see that the owners of the property that sold the property are the same as the owners that bought the property. A case I had recently was a limited partnership was the seller of the property, and it was kind of funny, but the limited partnership was not really it was basically 100% owned by one guy. The one guy had a 99% limited partnership interest, and then his S corp was the property manager and held the 1% interest as the general partner. So essentially 100% of the activity flowed to his tax return, right? So for tax purposes, he was the owner of the property. So he didn't get great tax advice, but when he did his exchange, he then took title to the new property in a single member LLC, in which he owned 100% of. So you'd think economically, from a tax standpoint, he had 100% of the activity flow to him, the old property, and then 100% from the new property. But that's not that for tax purposes. That's not the same seller and buyer. Our seller was a limited partnership with two members. regardless of who that activity flowed through, our buyer can't be an LLC with one member. So I think that's where I see it the most is people not being careful, not doing their diligence on who the buyer and seller are of the property.
Yeah.
Yeah.
So that's a good point as to where the attorneys get involved. Where the accountants kind of get involved, right, is in actually reporting these and preparing the returns and understanding that the basis from the old property carries over and actually continues its life as if the property had never been sold. It's almost reported as if that property had never been sold for depreciation purposes, and then you stack on top, any new basis, and obviously you have to make allocations depending on what the value of the land and the property are. So, just wanted to throw that tidbit in there for the firm. All right, so good conversation about 1031 exchange. Let's take it a little bit higher level. We talked previously about profits interest and capital interest. Now we're talking about like a very, very specific structure where and what I'm getting at is the carried interest, right? Which is where you have a member manager or a general partner who's putting together a fund and raising capital to go out and acquire real estate, and it could be any activity, right? But today we're talking about real estate. And so let's talk a little bit about carried interest and the mechanics of that and how it works and how it benefits that general partner.
Sure. I'd love to. I think apart from some of the other tax changes we've touched on, the 199A deduction, changes to the carried interest is probably one of the other main areas that the new tax laws in 2018 have impacted. So to kind of build on your example there, in the old days, your profits interest member, your developer, whoever, could go out, raise the money, develop the property, do all that, and then when they turn around and sold the property 1 year later, after a property, a piece of land has been developed into an apartment complex or something, when that developer sells, like everybody holding a property for 1 year, you get long-term capital gains treatment.
Right.
But if you really think about that profits interest guy, that developer, he's basically put a bunch of services in, and now he's getting paid for basically his contribution is his services. And in under normal other circumstances, not normal circumstances, but I guess other circumstances, services, service payments, you pay ordinary income rates, right? And you pay self-employment taxes. But the way the carried interest worked, again, the carried interest is a way to describe a profits interest for a developer or somebody in this service provider in this context. In the old days, and I say old days meaning prior to 2018, you sell that property and his gain share is all taxed at long-term capital gains rates. So people looked at this as kind of didn't make sense to some, kind of a perk that real estate developers and people in the real estate industry are getting that to a normal taxpayer may seem unfair or something. So this is something that was kind of on the chopping block. Part of, kind of the way they talked about these 2018 tax law changes was we want to simplify the tax code. We want to, eliminate loopholes. We want to make it more fair or whatever. That's how they talked about it. But, as you mentioned, like with 199A, we still need more guidance. It's not simplified. Things are as complicated or more complicated.
Maybe a little bit less complicated for an individual who's an employee and that's their only source of income, but definitely more complicated for investors and business owners.
And things were kind of rushed as we don't have full guidance on some of these new aspects of the tax law that people are still figuring out. So to kind of get to the point, the carried interest has been, a good advantage to developers and people with profits interests in LLCs. Well, the laws have changed. You can no longer get long-term capital gains treatment on your carried interest after holding the property for 1 year. You now have to hold the property for 3 years. Okay? So when you put capital in, you invest your money, you can still get long-term capital gain, holding a property for a year. But for these developers, for these profits interest and carried interest holders, you got to hold it for 3 years. So it kind of closes a bit of that structure or loophole to this advantage that real estate developers were getting. And not just real estate developers, but anybody in this type of structure that's acquiring real estate or managing real estate that was taking the profits interest. You got to realize now if you do the same kind of 1 year turnaround or something, you're not getting long-term capital gains treatment.
Yeah.
You got to hold that property for at least 3 years now to get that benefit. And that may work for some, maybe in like a rental property context, but more of a develop and flip or something like that.
Gotcha.
Those people probably don't want to hold property for 3 years until they can move on to the next one, because they want to redeploy their money more frequently or whatever to kind of keep building. So
and here's the plug for you, Mike.
Yeah.
Okay, you need to have an attorney that understands this carried interest during the formation and the raising of the capital, because there are elections that you have to make early on in order to notify the IRS that this is a transaction that may be taking place, right? And then it has to be written as such in the partnership agreement, and waterfall provisions and all these other things need to be accurately and very specifically written in that documentation. And then you need an accountant that can actually read it and report it and calculate it.
I think I reiterate that on both fronts. I mean, I think with this being buttoned up how it has been, people are going to try to plan around it now. They're going to try to circumvent their new rules and stuff like that. So you need to be careful in your partnership agreement and your docs, and then on your tax reporting to make sure that you're reporting things properly. Yeah, I think that's good advice.
Great.
Yeah.
Okay, sounds good. So what we're going to do now is we're a little bit past 5:05. Yeah, so it's 5:05. If we have any viewers out there, we're going to be taking some questions. If there are not questions, we'll just continue the discussion and go through.
Sure.
Okay, so that's why I wasn't being rude. I was pulling out my phone so that I could figure out if there are any questions.
Good.
All right, we have some viewers out there. Hey, Ryan, Aaron, Daniel, Jesse, Sarah. I'm not going to pronounce that name. don't know how to pronounce. Sorry, I don't know how to pronounce your name. You know who you are. For 1031 purposes, are REIT common stock considered REIT interest? Okay. So is the stock of a REIT considered a real estate interest for 1031 exchange purposes? Is the question?
Yeah. That's a good question, and that is something that has been kind of people have raised that question before and now has been clarified. Yes, your interest in a REIT is a qualified interest of real property for purposes of 1031. What I heard the word there, REIT stock. And REITs are kind of a unique animal. They're not necessarily, they're not a partnership. They're not an LLC. There's some are set. Actually, most are set up as real estate investment trusts. Some are actually set up as corporations with stock, but they're taxed as real estate investment trusts. It's kind of confusing. It's kind of a state law circumstance on whether your REIT is trust or a corporation with stock. But I think that's right. I think if it is a REIT, whether that be one that sells shares of stock or one that sells units, as a trust, that investment should be qualified as replacement property. So
okay, sounds good. Let's see. Any other questions we have out there? Now's your opportunity. You saw the circular 231 in the beginning, but we are answering questions. We are answering some questions here.
Yeah.
All right. If there are no more questions, any other topics we want to touch on? It's like 5 o'clock now. So
yeah. I don't know. I think we
covered a good amount of it.
Well, remember, if people watching this in the future, you can always send us your questions at a later date, or you just didn't get them in time. We're happy to give you our opinion as well. It's having experience with these transactions. We kind of do see the same questions a lot. And, those things hopefully can be easily answered. And, we can provide some help to you if those kinds of things come up. So
okay.
Yeah.
Great. So I'm going to sign off. Before we sign off, thank you very much, Mike, for showing up, taking time out of your Friday.
Yeah.
Thanks very much, Bobback.
Yeah.
You're here anyways, but but thank you for showing up. Oh, Mike, obviously, it's on our website, so people know where to find us. Where do people find you?
Oh, yeah. So I'm Mike Page. I'm with Rutan and Tucker, which is a full service firm in Orange County. Our offices are in Costa Mesa.